Good afternoon. I hope this week's episode of Wall Street X's and O's finds you doing well. Hey guys, this is Craig Modelmog, Cornerstone Wealth Management for this week's episode of Wall Street X's and O's. I hope everybody's doing good. I'm fired up. I'm really excited to be here today. Today is Friday, April 15th. We have till Monday to do taxes, so I was going to say tax day, the infamous tax day. I know my son, who is a CPA for Ernst & Young, he is praising the dear Lord that this week is over. He has been ripping and roaring doing corporate taxes, and he's having a blast, as I'm sure you can imagine. But anyway, hey, it's all good. It is all good. I've got a great show for you here today. But before we kick things off, we've got to get on with the disclosures. We want to be prim and proper here. So I'm going to give you all about 5 seconds to speed read this thing, okay? I was going to read it to you like I've done in the past, but I'm just not. I'm just not today. I'm just not feeling it on this Friday with disclosures. But anyway, it is all good, I tell you. So moving on, I've got a really good show today. I'm really excited. There's a lot happening in the markets, both from a global standpoint as well as a domestic standpoint. And today we are going to focus on, again, our top 3 things, and then we're going to segue and close things out with the things that make you go, Moving on here, number 1, global macro performance update. It's been a rough year. I actually read an article here where they said if you are down less than 10%, you should be applauding. I'm not trying to give myself a pat on the back here for being down less than 10, but it is brutal out there, and we're going to talk about that. Inflation, moving on, number 2, could it be peaking? I think yes, and I'm going to show you some statistics and data that will support that. Now, obviously, we have to see if this continues to follow through, but as of right now, there are some signs that we could see inflation peaking. Number 3, we're going to give you an interesting data set. Oh yes, this is a good one. This is actually a really good one. And then we're going to close it out with things that make you go, Moving on here, global macro performance. I tell you what, it has been a rough year, like I said. And, you know, the proof really is in a cross-section of the investment asset allocation options, whether it be stocks, whether it be bonds. It really doesn't matter. Very tough year. The only things that we're seeing really perform happen to be on the commodity side of the ledger. Taking a look here at this slide, you can see now this goes through the end of March, okay? If you look at the beginning of April, these numbers are actually quite a bit worse here. And you can see today I have a laser pointer. Look at that. Someone said, Craig, don't you have a laser pointer? Yes, I do, and I aim to please. So I know Trudy is laughing right now. But anyway, as you can see, if you look at the end of March, the S&P was down 4.6, high yield bonds 4.8, international stocks 5.9, global ag was down 6.1, world stocks 6.2. I'm going to go down the small caps. This is the Russell 2000 down 7.5. The 10-year Treasury, yes, I did not stutter, down 8.5. You've got emerging market bonds down 9.2, and the ever-loving 30-year Treasury down 15.5. Yes, that's a big 15.5. That is brutal. Moving on here, let's look at the sectors. Obviously, it's not a shocker where we see energy here being the number 1 sector. And then I also can draw, look at that, energy. I tell you, I am just welcome to the 21st century, Krager. You know what, that's all I can say. Basic materials, number 2, utilities, number 3, consumer defensive, that are staples, okay? Everything else, you know what that is? That's a big negative. That's healthcare, that's real estate, that's industrials, that is communication services, that is consumer cyclicals, and the big one here, people, the big one are these 3. Okay, you know what these 3 are? This is Apple. See, I can't even draw. This is Apple. This is Microsoft. This is Amazon. And this is Google. Okay? If you own those four, you could even throw Facebook in here, actually. Those are the big ones. If you own any of those, you are getting smoked this year, and it is painful. I actually think that pain could grow in those names, okay? Not to be Debbie Downer or anything, but you know what? I think there's a lot more air in those names because they've been so overly owned, like we talked about 2 weeks ago, and that they're such a big part of the S&P 500 from an ownership standpoint that as things drop, eventually people get nervous and eventually people sell things. Moving on, this is another really good one here. What I find interesting, and I'm going to draw this line here, all these here, you know what these are? Commodities. Commodities. What are all these down here? These are the things we buy. These are things like 2-year treasuries. These are things like 5-year treasuries. These are things like 10-year treasuries, 30-year treasuries. You've got the NASDAQ here down 14.88. You've got lumber. Hey, I just bought some wood. I'm getting ready to build a pergola in my backyard. Lumber's down 22%. Here's a good story for you. I had lumber quoted last fall. From the prices last fall to this week when I put in my order, the price dropped like by 40%. That's a big deal. That's a really big deal. So again, unless you own a lot of these things here, which are all commodities, this is where the plus is. All of these down here are the big negatives. S&P, again, down 7. It's been rough days out there for investors. But you know what? It's okay. We have these periods. The key is not to panic. Okay? You don't panic. You don't throw the Hail Mary on 3rd down. You just don't. Okay? You just got to take a deep breath. And that's what I'm trying to do. And that's what I really hope that you try to do as well. Moving on here, inflation, could it be peaking? I think yes, okay? I really do, and I've got some really good stuff here to show you some areas that are starting to show that inflation is in fact peaking. Here's an interesting one, used car sales. So if you look up here, used car and truck sales fell 3.8% for the month of March, okay? Here's what I find interesting. You look at all these peaks here on when they've happened, they've also coincided with inflation. As they drop, inflation begins to decline. Used car and trucks are a pretty sizable piece of the inflationary number. Now, it's not the biggest one, okay? The 2 biggest ones are oil and energy, and number 2 is shelter, which is rent and housing prices. But again, you can see that used car prices are coming down. If you are thinking about buying a used car, wait. If you're thinking about buying a used car, this actually is a great time to buy a new car. I did say used car. I said used car twice. This is actually a good time to buy new cars. Why? Used cars are higher priced than new cars, which is fascinating. So if you can afford to buy a new car and wait 6 months to 9 months, buy a new one. This is a good time. Before interest rates go up even more. If you're buying used, hold that decision if you can. Moving on here, commodity prices are deflating, okay? Here's what I'm talking about. You've got these big 3 here. You've got lumber, you've got coal, you've got platinum and crude oil. And you can see where the peak was back here in March for a couple of them. You had lumber back here, actually lumber twice. You've got crude oil here. Then what are we seeing? We're seeing a big decline in pricing, okay? Moving on here. Here's what else we've got. We've got oil. We've got Brent. We have gas. Thank the Lord, gas prices. You've got cattle. You've got wheat prices. You've got coffee that peaked and then has come off. But here's what we're seeing. This is March, okay? The month of March on my charts. Here's what's kind of cool. What are we seeing? We're seeing a trend reversal across the board, okay? Now, to be fair, there are things that are still elevated. What they are, natural gas, still a very strong trend. Corn started strong, flattened out, taking off again. Soybeans were strong, but then in March, flattening out. Cotton, sold off, but then you saw it retrace, and now we're back into another strong trend. Orange juice, we had a little decline, flattening. Orange juice is fired up. Why? We had a cold March. Remember the freeze in Florida? That's what happened. See that? That's crazy. Sugar is another one. Kind of was in a decline since the beginning of the year, but then we've seen a couple moves in sugar, okay? Those are things to pay attention to, because a lot of the commodities is really what is driving this high inflation number, okay? We need to remember, again, what the top two are: oil and energy, and number two is shelter. Oil and energy is already coming off, as we've seen. Shelter is going to take a couple more months. That is probably going to happen midsummer, is what the data is reflecting right now. We got to wait on the math. But again, what the math is showing is that inflation is beginning to roll over and decline. This is interesting. What is also going to add to that decline, and this is why I say shelter is going to be delayed. Here's what's happened. Most recently, we have seen one of the biggest moves to the upside. And I don't want that one. See, man, I was doing so good, and then I pressed the wrong button here. See, mortgage increase 31.7%. That's going up just since the year. And you can see, the year-over-year percentage change, as I'm reading to you here, in estimated monthly mortgage payments is greater than 30%. Currently, it's the fastest growing rate we've seen since the 70s and 80s. That's what's happened right here, okay? That's a big one. Here's the 70s right here. Here's the 80s. And these were big increases when it comes to mortgage prices. Now, what does that do? This plays into my delay in the slowdown in home prices and in home purchasing. If interest rates are rising, if you remember last week, I showed that slide where it said if you wanted a $1,500 a month payment, okay, 2 months ago, that would have bought you a home price for $369,000. Now, fast forward to today, okay, interest rates now for a 30-year fixed are north of 5%, okay, plus 5% on an interest rate. So what does that mean? Now your purchase price on a home is, it is only, and I got to read here, $293,000. You know what that is? That is a 20% decline in your purchasing power. What are we seeing already? We're seeing the number of homes out there in inventories begin to expand. We're starting to see prices in a few areas of the country drop. Not yet. That's what's going to come this summer. You got to watch and wait. But this is really setting in to happen. We just got to be patient. An interesting data set here. This is a good one. The NFIB, which is the National Federation of Independent Businesses, they do lots of economic surveys with small business owners, okay? This is what's fascinating here. And I am going to get my little pointer here. The most recent survey just came out for the month of March, okay? They obviously hit small businesses. They want to kind of get a feel for what's happening. Recorded a 14-point month-over-month decrease to minus 49. What that means is that's the lowest reading on record. And that goes back 48 years, okay? Same survey said that they looked at business owners, are they going to be raising their prices? The answer is yes. It increased by 4 points to 72% seasonally adjusted. Again, highest reading ever in 48 years. For some context, the next highest reading, which is the number 2, this is the number 1. So both of these here, okay, are in the number 1 spot. These are number 1, okay. The last time this happened, you know what was going on? Look at this. Mid-1970s, specifically Q4 of 1974. What was going on? In December of 74, what was inflation? 12.1% year-over-year increasing, okay? We're pushing 9 right now. What happened a year later? Dropped to 7.1. That's 5 points. You think, well, that's not very much. No, that's like a 40% decrease in inflation. 2 years later, what happened? It was down to 5%. Okay, so inflation does elevate. It doesn't remain elevated. Okay, that's what concerns me about the Fed getting ready to really aggressively raise rates when things are already starting to roll over. Makes me a little nervous. This is really what gets me concerned. Guess what happened during the growth of 1974? This is economic growth. Okay, what happened was the economy was in a recession for the entire year. Okay, what happened in the S&P? It was down 31% in absolute terms. When you factor in inflation, which inflation was plus 12%, you take 31 and then you subtract 12, or actually you add 12 to that, which gets you to what? Minus 43% total return on the markets. Now, I'm not trying to blow a lot of fear out there in you guys, but I'm just saying the last time we saw economic numbers or surveys from small businesses, this is what was happening. This is what concerns me. This is why I've been really moving more towards the defensive side of the ledger since November, which because bonds have been so garbagey, that's why we're getting killed. That's why it's really hard, but you have to hang in there. This is not going to last forever. Eventually, the markets figure out what is going on. What happens during times of a economic decelerating along with inflation, and then you add to that the Fed raising rates. The high performers are going to be treasuries, it is going to be the US dollar, and it is going to be gold. Historically, that has been really the three best places to be. On the equity side, utilities do well, staples do well, anything defensively, you can even throw real estate in there. All right, we've been slowly migrating that direction. You've got to be patient. All right, closing it out here, things that make you go, Going back to 2020, this is interesting. Actually, looking at 2021, this shows the top 10 states where people move to: Florida, Texas, Arizona, Carolinas, Tennessee, Georgia, Idaho, Utah, Nevada. These were the top 10 outbound. You want to know something interesting here? You know what these 10 were? And some of you might throw up when I write this down. All 10 of those states voted for Trump in his election. What are all these here? Well, I'm telling you, they're not Trump states. Things that make you go, And I'm not going to expand on that one. Moving on. Trade as a percent of GDP. Okay, Craig, you probably say, well, why is this a big deal? Well, if you look at this, going back to 1960, what is this? This is a very strong trend. Okay, it's very, very strong. What is this? This is the great financial crisis. What is this here? Pandemic with the capital P. What is this here? Russia invading Ukraine. Here's what's happened, people. Okay, obviously we saw a contraction in globalism during the great financial crisis. We saw another contraction during the pandemic. Why? Everything got shut down. What are we seeing now? Well, now we've got geopolitical risk rising in Eastern Europe with Russia attacking Ukraine. Here's what's interesting about this, all right? When you look at what happened during the pandemic and now during this geopolitical issue that's happening in Ukraine, we've seen a lot of pressure on what? Supply chain, right? Well, what has happened during this here, okay? This massive global expansion, and globalism was expanding going back to the 60s. What was happening? What did the US do? They offshored everything. Every company in the United States offshored production in some way, shape, or form. Why? To save money. Why? So they can make more money for shareholders and for themselves. Now fast forward to the pandemic, when all of a sudden China made 90% of the world's supply of a lot of the gowns, the masks, things like that. China and a lot of other Asian countries supplied most of our antibiotics, most of our medicine, and the things that our healthcare system was using to treat people. Okay? I hope we're learning from this. Globalism, I think, is fantastic. But you know what? You can't sacrifice everything just for $1. Although, you know what happens? That's what happens. Okay? I'm anxious to watch and see if this continues from a standpoint of we have a peaking here in trade as a percent of GDP. Is this going to come down here now? I don't know. We're going to find out. The next coming months and years, more likely, are going to be interesting to see if this blue line continues down this direction. We shall see. Last thing here, phased retirement programs. You say, Krager, what do you mean by that? Well, what I mean by that is they took a survey, and you've got in the blue here, this was 10 years prior. Okay, then you've got in the black, and this is the last 10 years. So this is 2000 through 2009 is the blue, and then you've got 2010 through 2020. The blue's increasing in the areas where people are aging. Okay, what does that mean? What that means is that people in their 60s and 70s now are doing a transition. They're either doing a transitional retirement, where you can see here that when they looked at workers age 61 to 66, that roughly 29% wanted to reduce their work hours, okay, and they wanted to gradually retire. Now, only 15% actually did it. Now, if you go again amongst pre-retirees and recent retirees, you're seeing there's a higher than average household savings, okay, which it goes with these increases in income, which means they're working longer. Now, 17% of all people that were either pre-retired or already post-retired are doing things in retirement, which I think is super healthy. Keeps your brain, keeps your body moving. It's all good. So anyway, this was fun today. Thank you for joining me. This is Wall Street X's and O's for the week of April 15th. You know what? I'm getting better with my new little toy here. I hope this is really getting more informative and starting to really bring together all the things that I'm seeing out there in the economy and their impacts on the markets, which then impacts our investment portfolios. I want you guys to get better. I want us all to be better investors, but you've got to look at the particulars and allow that to drive your investment decisions versus the emotions. Again, April 15th, 2022. Thanks for joining me, Craig Modelmog, Wall Street X's and O's, and I am